All right, so let's take a look at an exercise. This is from our textbook, and it's got the name of the exercise right up here. It says applying the accounting equation. Okay, so if we review the information in the textbook, that part should be fairly easy. And assessing financing contributions. Okay, so this is the way that they were asking us this question here in your homework. It's going to end up being a drop-down menu box, and so you could probably figure out the answer. But we do kind of need to know the why. Okay, so let's see what we have here. I'm going to try to bring up a calculator. That a little bit smaller because we are going to need a calculator, I believe. Yeah, so that'll work. So it says, using the accounting equation, it says determine the missing amount from each of the separate situations A, B, and C. And so what they've done here is they've given us three companies, Motorola, Kraft, and Merck. And if you'll notice here, we have the accounting equation right here. And so the accounting equation is assets equals liabilities plus equity. Okay? So normally, under normal circumstances, assets are going to be the largest component of this equation. Now we do have an exception to that here. So Motorola Solutions, these numbers are in millions, but I'm going to read them just the way they have them here, has assets of 8,208. Okay? So we're trying to solve for liabilities, right? Notice that equity, okay, which we can describe as essentially net assets. For example, you know, we can rewrite this equation as assets minus liabilities equals equity. Okay, we can do that. Now that's not the accounting equation. This is the accounting equation here, but we can rewrite it like this to help us make a little bit more sense out of it. So anytime that equity is negative, that means essentially that the owners of the business have a negative claim on assets, or that's another way of saying that liabilities exceed assets. So if we wanted to figure out what the liabilities were, we can tell that liabilities are the biggest component of this equation. So all we really have to do is just take our assets of 8,208, and here's the trick, we're going to add 1,742, okay? And that's going to give us liabilities of 9,950, okay? And so if we can prove this by applying this alternate formula up here, and we can say, okay, assets of 8,208 minus liabilities of 9,950 equal, and there's our negative number for equity. So we know we have the right answer. Liabilities are 9,950 for Motorola. Okay. Clear this out here. Now, Kraft Foods Group Incorporated, we can just follow this accounting equation exactly as it is. We can say that liabilities of 53,958 plus equity, let's see, did I hit that? 66,034 equals 119,992. Okay, that one's a little bit more straightforward. Then if we go to the Merck and Company Incorporated, we said that assets are usually the largest component of this. Now I want to go back kind of to this little formula, this alternate formula, and I just want to use some basic subtraction here. Assets of 87,872 minus liabilities of 53,303 are going to provide us with owner's equity of 34,569. Okay, and so that's fairly straightforward. If we know anything at all about the accounting equation and some basic algebra, well, then we can answer this question. Now, I want to move this paper up just slightly here so we can still see the companies. Let's see if I can maybe just, we don't need our calculator really anymore. So let's get that out of the way. Down here in the second part of the question, it says, which of these companies is more owner financed? And which of these companies is more creditor financed? So if, this is a fairly heady concept here, because we need to know what the components of equity are to really be able to answer this question. Okay, and equity is comprised of two things. So when we talk about equity, it's got two components: owner contributions. Owner contributions, otherwise known as stock. Okay, and then also retained earnings. And retained earnings flow from the income statement into the statement of stockholders' equity. We subtract out any dividends paid, and then what's left goes to retained earnings. I said statement of stockholders' equity. Probably the easier way to say that would be the statement of retained earnings. And so if we look at these, now the other way that we can talk about financing contributions is not stock, but the other way that we can finance a company is through debt. And debt is not necessarily synonymous with liabilities, but they're pretty close. All right. So when we look at our little square up here, we can see that Motorola Company has a lot of debt, and so this is an indicator that they are being heavily financed through bonds. They're probably issuing bonds or obtaining financing by going to a bank. For a large company like Motorola, they're probably issuing bonds. And then we look here at the other examples and we say, okay, got a lot of equity here with Kraft. Their debt in relation to their assets is actually pretty low. And then with Merck, this is, they've got about the same amount of liabilities, but their equity is less. So we can say that probably this owner contribution component of the equation is less for Kraft Foods. So keeping all those things in mind, and again, this is a fairly heady concept here. We would say that the company that is most owner financed would actually be Kraft, and the company that is most creditor financed would be, Motorola. Get this page to be still for me. All right, that's it for this video.